guys have to just do a bunch of crazy.
Hey, it's Weisenthal, and it's time for a special Brexit-themed edition of the Chart Show here on Facebook Live. It is an extraordinary big day in markets. It's a historical day for global politics after the UK voted last night to leave the European Union. So much happening today. Let's take a look at some of the charts and some of the numbers that shows how the market is reacting to this news. So let's come here real quickly. This is just a screen I'm looking at. It just shows real quick look at markets around the world. US really not taking it really in stride. We have the Dow Jones and S&P off around 2%. I think people, people are nervous about it, but there's no obvious reason why. It has to be too bad for US, at least in the short term. So not big losses, but not catastrophic by any means. Much more dramatic in Europe. Euro stocks, which is across Europe, down over 7%. Germany down over 6%. France down over 7%. Spain is down 11%. That's the IBEX 35, Spain's big index. That's really important because Spain has new elections coming up this weekend, so a lot of anxiety about political risk. Italy is down over 10%. They have their own constitutional referendum coming up this October. So, just lots of anxiety about what this means for Europe. And then specifically, will there be a contagion? Will there be more countries that try to, do something dramatic, change their political situation? So you really see it getting hit. Let's take a real quick look at, the story of the day of the last 24 hours has been the pound. Let's look at the last 3 days, actually. So here's a 3-day chart of the pound. Actually, let's first take a look at a month, so we just go back. As you can see, in sort of the middle of June, the pound had fallen a bit. There was a lot of concern that, they were going to vote to leave. Then the polls appeared to be shifting in favor of Remain. And you could see that the pound essentially had gone in the middle of June from around $1.40 to the dollar to close to $1.50. Last night, there was a big surge in the pound right after U.S. markets closed. There was a poll that had come out that seemed to definitively show that there was a big shift to the Remain camp. People were feeling very good. People was like, okay, at the last second, it looked like everyone is back and they were going to stay in. And then let's really zoom in on the last day. Right around just after 7 o'clock, the Remain camp got its first indication that something was going wrong. The towns of Newcastle and Sunderland came in, and both of them were much worse for the Remain side than some of the political scientists had expected. So we sort of saw the pound dip, then it stabilized, and then through around midnight, just this epic pound flush, the biggest in a really long time. Let's check out this chart that shows, it really just puts it into perspective. I think this is the chart. 1 second. Not sure. Oh yeah, here it is. Look at this. This is every pound move. This is every daily pound move going back to 1992. This is Black Wednesday, the day supposedly when George Soros broke the pound. This is every pound. Look at that. Look at all of these moves, and then look at that move right there. 7.3 decline. Just epic. I mean, this entire thing. You could just see how that stands out. There's another way of looking at the extraordinary move in the pound, and this is the HRH function on the Bloomberg terminal, the historical return histogram. This is every pound move just for the last year, and so you can see the pound tends to cluster between up 0.25%, down 0.35%. This is sort of the distribution. If you look way out here on the left, this is how, we just haven't seen anything like this move in the pound. You can just see how far outside of the normal behavior we saw in the pound last night. Absolutely extraordinary left tail, mind-blowing stuff. Let's take a little bit more, let's take another look. Actually, before we do that, let's look at one last thing that sort of shows how the night unfolded last night. And so this is the odds. This is a chart that looks at the betting market odds of whether, based on all these UK sites, like where people actually gamble money. going into last night, it was about 80% people were thinking that they were going to vote to remain. Then after those early results, it started tumbling. But a long time through the night, look, even as of 10 p.m. last night, it was around 60%. It took people a long time to finally accept that it looked like the UK was going to vote. And then after 10 and more towns started coming in that showed that Leave was going to win, you can just see the complete collapse.
Someone wants to know if you have any idea how those polls got it so wrong, because there were some polls that definitively said.
That's a great question. So the question is, how did polls get it so wrong? And this has been something that's scratching the heads of political scientists everywhere, especially in the UK. I mean, there was a general election last year in the UK. The polls got it wildly wrong. Almost nobody thought that the Conservatives would get an outright majority of the UK Parliament. Of course, they did. I don't have an answer. I think there was a lot of debate about methodology this time because there was a pretty big gap between phone polls, which consistently showed more inclination to remain, and online polls that showed more of an inclination to leave. You know, maybe there's a generational thing, but that doesn't totally explain it because young people more voted to remain, and so you'd think that if young people were more inclined to do online polls, then it should be the other way, but that wasn't the case. It could be the kind of thing where maybe people felt ashamed telling pollsters that they were inclined to leave and didn't want to admit that because they thought that was embarrassing or something like that, so that online they were more willing to be honest than if they were actually talking to someone on the phone. But there's going to be a lot of analysis and study about polls for a long time because so many people depend on polls and are so used to using polls to accurately gauge the mood that if for various reasons polls stop working or polls getting less accurate, that has huge implications. Let's take a quick look at what this means for the Fed. I mean, this is absolutely extraordinary. You can see that basically with this huge global move, the odds of a rate hike this year are gone. And so the July meeting, 0% chance of a hike. September meeting, 0% chance of a hike. November, 0% chance. This is market applied probabilities. You can actually see the market is implying a slight chance of a rate cut in the coming meetings. That was basically up from 0. So that's a pretty extraordinary turnaround. If we just look, so, you know, we have the 0% chance of a hike in July, and by December, just a 10% chance of a hike at any time the rest of the year. If we just look 2 days ago, we were at a 43% chance of a rate hike by the end of the year and still an 8% chance of a hike in July. So you could just see how everything is completely flattened out in the markets. It went from being a significant chance of another rate hike this year to basically no chance seen by the market. So that really drives home how much this Brexit referendum is having on global markets and the Fed and everything else. You know, if we looked at other central banks, you would see similar stuff. Let's look at the world currency rankings. So we know that the pound got smashed, but there's some other stuff to look at on the currency front. This is pretty interesting. So this is the G10 currencies. The only currency that's up on the day is the yen. The yen is sort of a classic safe haven currency. It's insulated against, you know, what's going on in Europe. The yen is surging. It's up over 3% against the dollar. Obviously, the big loser of the G10 currencies is the British pound, but everything else, the Canadian dollar, New Zealand dollar, Australian dollar, everything else is getting slammed. If we expand the basket a little bit to the so-called expanded majors, you know, we sort of see a similar thing. Only the yen is up. Pretty much everyone else is down. The pound again, Norway, Sweden, Poland, Colombian peso, Hungary, Argentina, everything is getting slammed. Pretty much only the yen is having a good day against the dollar. Again, really just shows how much this this referendum is affecting things.
Do you see the pound continuing to fall?
I honestly don't know. I mean, I don't know what's going to happen with the pound or really any other asset class in the future. I think a lot of what happens now is going to be, you know, there's so much uncertainty on so many levels about what's next, because this morning David Cameron, the Prime Minister, announced that he intends to resign in 3 months. We don't know who's going to replace him. The Out campaign, the people who advocated leave, it's unclear if they have a unified vision for what's next. Do they want a complete break from the EU? Do they want some sort of quasi break where they leave the EU technically but retain free trade and some semblance of free labor movement? Nobody knows what is going to happen with that, and so there's just this extraordinary amount of uncertainty now. And you have to figure that if you're a business and you're going to invest in the UK, you might be facing years and years of an unclear business status there. And so I think that really explains the intense negative sentiment. If it were one thing where just like UK were going to leave and everyone knew it was up, then they could just sort of reset expectations. But right now, it really feels like everyone's stabbing in the dark, trying to figure out what's next. So really, who knows? One thing that's doing very well is gold.
Oh yeah, everyone's asking.
Everyone wants to know about gold, of course. So let's get a nice look at how gold is doing real quickly. So this is a 1-year chart of gold. 1 second, just got to update. So this is a 1-year chart of gold. Gold has already been, I mean, this is December 31st. This is the start of the year. So you can see gold has just gone on a massive tear this year. It was around 1070 at the beginning of the year. It's now surged to over $1,300 an ounce. Massive start to the year for gold. If we look at the last 3 days, it's sort of, I mean, that is an epic move in gold. Let's see. Let's look at how much of a swing we got in gold. From the bottom when it looked like they were going to vote to remain. There we go. It was an 8% move in gold from around 6 p.m. last night, which was like when it really looked like they were going to remain, till 2 in the morning when that was the worst. I mean, obviously you could see it's come off a little bit, and part of the reason for this dramatic swing is that in those hours there might not have been a lot of liquidity. Markets tend to hit, they can hit an air pocket where there's a lot of people wanting to do a one-way bet, and because it's late in the middle of the night, and for a lot of traders, particularly U.S. and European traders, there isn't a lot of liquidity in markets, so you get these unbelievable moves. If we go back to that HRH function, the historical return histogram, so gold is up about 4% on the day. You can see this is the last year of gold trading, and gold trading is fairly volatile, but this is the second biggest up day of the year. So a pretty extraordinary move in gold, well outside of what you would imagine the standard distribution of gold would be. I just want to show one more crazy chart. This is an unbelievable chart. Check out this, and so this really goes to speak to like how intense the market dislocations were this morning. And just like the volatility. This is a chart of a company called Red Row. It's a UK home builder. It ended yesterday at 426 pence per share, about that. It opened today at 100. There's basically a 76% move, and then immediately it erased much of the loss. It's only down 13.7%. But when you see charts like that, that is just a combination of no liquidity, nobody wanting to do anything, and massive panic. I mean, it's very rare that you see a company plunge 75%, more than 75% right at the open, and then erase, 80% of those losses thereabouts. So we're just seeing, the home builders are expected to be particularly hard hit. They're one sector. Another sector that you want to check out is look what's going on with like banks right now in London. So like Barclays, just as a quick example of a bank getting absolutely smoked today. 3-day chart shows it really nicely. Just this huge plunge. It was over about 185 pence a share yesterday. It opened today just over 130. It's come back a fair amount. It's now only down 12%. But it's just incredible moves for these companies that are these sort of giant financial institutions that are supposed to be, the pillars of the economy. Incredible moves at the open in London this morning. Let's get a quick look at how U.S. markets are doing. You can see nothing nearly as dramatic on the U.S. side. A little bit of weakening, but still just down about 2% for the Dow Jones, S&P. Down a little worse for the NASDAQ. So we saw there was really intense action late at night from about 10 to 2 in the morning. And then at the London Open this morning, just utter bedlam. Things have calmed down. What else do people want to say?
Question. Can you just explain why the yen is the only currency that's up right now and what's going on in the Asian markets?
Yeah, so, let's go back to the yen. It's sort of, there's a lot of things going on with the yen. So let's look at a long-term chart of the yen real quickly. So let's first look at a 5-year chart of the yen. So this is a chart of the yen against the US dollar. So that means when it goes up, that means there's more yen to the dollar. That means the yen is weakening. So starting in like 2012 with the new government, the Abe government, there was a lot of easing going on, and aggressive monetary and fiscal easing. So we saw a lot of yen weakening, which was the idea. But ever since middle of 2015, we've seen this big reversal. So if we look at a year, I mean, the yen has just been strengthening and strengthening and strengthening nonstop. Last summer, it was 125 yen to the dollar. It's down to 102 to the dollar as of this morning. I think there's a few things, but the yen has this sort of classic safe haven role, in part because of capital flows, because of the trade deficit. There's always just sort of a lot of money that flows into Japan, the trade surplus. That means it historically has it's extremely stable country. From an internal political perspective, there have been a lot of governments, but people don't expect any sort of like dramatic rupture in how the government works particularly. So for lots of reasons, it just sort of occupies this space as the safe haven. Another currency that sort of behaves like that is the Swiss franc. One of the charts that I've really enjoyed looking at over the last several weeks is a chart of let me expand it out a little bit. I really like looking at a chart of the S&P futures against the British pound versus the Swiss franc, because the Swiss franc is it's a local safe haven. It's not politically integrated. It has an extremely solid economy. It's still known as a place for safety and stability. And so you really saw the pound plunge against the Swiss franc last night, and you could see S&P futures in blue really tracking tick by tick. So these certain countries that are seen as embodying economic stability and political stability, and people like to pour into them as a safe haven. And the US dollar is, of course, in the grand scheme of things, quite a safe haven too. And that'll do it for today's chart show. Absolutely stunning day in markets. I think we're going to have a lot to look at and a lot to talk about for the weeks ahead. Thanks for watching.